In this video, we'll be sharing 7 of the most promising stocks to invest in for 2025. But that's not all. We'll also dive into how the current economic climate is shaping the markets and reveal the 2 key traits that the best performing stocks must have in today's world. Let's get started. What does the economic landscape have in store for us? A few weeks ago, we discussed which stocks might have potential for revaluation in 2025. However, a lot has happened since then. Donald Trump's return to the White House, escalating geopolitical tensions, and in the meantime, the markets have been on a bit of a roller coaster. This has been largely driven by 2 key factors. First, there's the issue of tariffs. This is, of course, to be expected. Higher tariffs typically lead to increased costs for businesses, higher prices for consumers, and a subsequent slowdown in economic output. This can, in turn, reduce profitability and heighten uncertainty. In fact, looking at the historical data from the past century, markets have genuinely underperformed in years that tariffs were imposed. Then there's the matter of inflation, which is still hovering around 2.8% as of February 2025, above the Federal Reserve's target. This makes it difficult to ease interest rates in the medium term. In other words, it's not just about the numbers, but the broader perception. So how should one invest in this? That's exactly why we're going to explore the 7 stocks considered during challenging market conditions. But here's where it gets really interesting. Not only will we reveal these 7 companies, but we'll also share the key characteristics of the types of businesses we should be looking to invest in should we face a year of financial volatility, or even a recession. Companies with solid fundamentals in challenging times and relatively low valuation multiples. To put this into context, historically, stocks with strong fundamentals have often led market rallies. In fact, since 2010, the market has declined by more than 15% on 4 occasions. In July 2010, December 2018, March 2020, and May 2022. And investors who bought stocks with a solid financial position during those dips and held them for at least 2 years saw average gains of 117%, more than double the return of the S&P 500. Before we get started, I just want to remind you that I'm not a professional financial advisor. My goal is to share information and analysis based on reliable sources to help you make informed decisions. However, this is only an opinion, and I encourage you to do your own research before investing. Now let's take a look at these 7 companies. The first company is Urban Outfitters, an American fashion brand that first emerged in the 1970s. It specializes in clothing, accessories, and homeware with a youthful alternative style. The brand is globally recognized for its urban renewal line, known for its vintage and limited edition designs. Looking at the numbers, Urban Outfitters boasts a stable operating profit of around $400 million, with a margin that grew by 75% last year and plans for a further 20% expansion this year. Additionally, its earnings per share surged by more than 90% in 2024, reaching $3.25 per share, and it expects another increase this year. On the free cash flow side, it made a strong recovery after the dip in 2023, increasing by more than 600% and surpassing any previous levels. Looking at the chart, we can see that its key support is at $48 per share, which could present a potential entry point, especially considering it's currently trading at just over 12 times earnings. Given the current market volatility, this could be an excellent opportunity if the price rebounds at this level. Next, we have Brinker International, a US-based restaurant company that operates and franchises various restaurant chains. Headquartered in Dallas, the company is best known for its Chili's Grill and Bar brand, which is renowned for its relaxed atmosphere and Tex-Mex inspired dishes. From a financial perspective, the company reached a new all-time high in January, following exceptional fiscal second quarter results, bolstered by an impressive 31% increase in comparable Chili's restaurant sales. Brinker's financial performance far exceeded expectations, with a 26% rise in revenues and a 3-fold increase in year-on-year profitability. The company has significantly raised its FY 2025 forecast, now projecting sales between $5.15 billion and $5.25 billion, up from the previous range of $4.7 billion to $4.75 billion, with earnings per share expected to reach between $7.5 and $8. Looking at the chart, it presents an interesting situation, as the stock is currently at the support line formed after the notable gap in early February. However, with a price-earnings ratio of 26 times, it's important to monitor the market's movements, as the stock might be slightly overbought at the moment, especially if the broader market slows down. Third, we have Stride, a US company specializing in online education software for students, vocational training, and other educational tools. Its flagship product is the K-12 platform, which allows families to enroll their children in accredited online courses, revolutionizing the way people learn in line with 21st century technology. Turning to the financials, Stride has consistently demonstrated EBIT growth of over 40% almost every year, except for 2023 when it was a more modest 5%. However, in 2024, the company bounced back with a more than 50% increase, bringing its profit to $250 million. The same trend was seen in earnings per share, which, while typically growing by more than 20% annually, saw a 60% increase in 2024. In terms of free cash flow, the company has also shown steady growth year on year, except for 2023, surpassing $200 million for the first time in 2024, following a 60% increase. Looking at the chart, Stride has formed an interesting support level around $114 per share, which could offer an attractive entry point should the market experience a correction. With a price-earnings ratio of just over 20 times, it doesn't appear overly expensive. I'm sure you've heard of our next company, Celestica, a Canadian firm specializing in electronic manufacturing services. It provides design, production, and supply chain solutions to companies across sectors such as communications, healthcare, and aerospace. Celestica has become a global leader in EMS, and its figures clearly explain why. Its operating profit has almost doubled over the last year, continuing an upward trend that began in 2020. The company also boasts a strong balance sheet with a solvency ratio of 1.5 and free cash flow per share reaching all-time highs of $2.57 in 2024, a 50% increase from the previous year. Looking at the chart, after a significant rally at the end of 2024, the price fell by 50% to $78 per share before bouncing back strongly. What does this indicate? Quite simply, it would be worth waiting for another pullback to that support level to take advantage of a more attractive valuation, as the stock is currently trading at 27 times earnings. So far, we've seen 4 shares, and now just a quick reminder that if you like this content, feel free to subscribe to our channel to not miss future videos and share it with someone who you think might be interested. And as always, you can sign up to our newsletter in the video description below. Our next company is Argan, one of the most talked about names towards the end of 2024, following the declaration of the energy emergency by the current US president. The company specializes in providing engineering, procurement, and construction services for the power generation industry. However, it's true that the start of 2025 has been somewhat negative for its share price. That said, this could actually be a positive development, as the stock may have been slightly overbought. Despite the more than 30% decline, Argan continues to demonstrate solid fundamentals, particularly its profitability, with a return on equity of 22%, a 70% improvement compared to the sector average. Furthermore, growth metrics remain strong, with expected diluted earnings per share growth of over 250%, well above the sector average. Next, we have DXP Enterprises, a US company specializing in maintenance, repair, and operations solutions for the manufacturing, energy, and petrochemical industries. It's particularly well known for its industrial pumping systems, which optimize fluid handling and transport. Most notably, DXP has outperformed the S&P 500, posting a return of 0.46% compared to the index's 5.14% decline since the start of January. Additionally, the company achieved record results in its fiscal year 2024, with sales rising by 7.4%, driven by an impressive 48% growth in its innovative pumping solutions segment. In terms of valuation, DXP trades at a 20% discount to its PEG ratio relative to the sector, presenting a potential opportunity for investors expecting an acceleration in 2025. With a PE ratio of just 20 times, it may be worth waiting for a pullback amidst the current market volatility, which could present a buying opportunity in the range between its current price and $70. And to finish off, we have an old favorite, PayPal. The US company is a pioneer in digital payment solutions and an undisputed leader in the world of e-commerce. As many of you will know, PayPal allows users to send and receive money quickly and securely and has become a global standard. And fun fact for the day, did you know that PayPal's founder was Elon Musk back in the mid-90s? Yeah, that's right. It was originally called X.com, which I'm sure rings a bell. In recent years, PayPal has faced some fluctuations in its profits, but what we find most impressive is its ability to convert earnings into free cash flow, with a 60% increase in the last financial year. This was driven largely by operational improvements and more efficient cost management, rather than by the sale of any assets. On the chart, PayPal looks particularly interesting as the stock has pulled back nearly 80% from its highs and seems to have found solid support in the range of $65 to $75. This presents a potential entry point for two reasons. First, its price has remained relatively stable over the past 3 years, which signals the strength of this support level. And second, its valuation is only 17 times earnings, which is quite reasonable, even low for a technology company. In summary, while it's still uncertain whether we're heading towards a stock market slowdown, only time will tell, the companies that will likely lead any recovery will be those with strong financial positions and relatively low multiples, like the 7 that we've discussed today. But now it's over to you. Which other companies would you highlight as having solid financial foundations and not trading at inflated multiples? Whatever your thoughts, leave them in the comments below. And of course, if you enjoyed this video, don't forget to subscribe to our channel and hit the notification bell so you don't miss any future videos. Thanks for your time, and I'll see you in the next video.